Okay, awesome. So I started off last week with introducing terminology. Can I just hear kind of from everyone where you guys landed? And it's okay if you're not very far on it, but where have you guys gotten to on Trainual at this point? Do you have a term, or if you haven't started, you can be completely honest.
I have like the last thing to do in lesson 2, which I
Okay.
just figured I was gonna do tonight, and then I was planning on starting lesson 3 tonight.
Okay. Perfect. What about you,
Just give me
Marissa?
a second. I'm pulling it up.
I'm kind of exactly where I've been doing the training, but I'm kind of where we were at last time we talked about the terminology in here.
Okay. Yep.
I'm done up to UCC.
Okay. Okay. So, since we did kind of talk about the first chunk of the terminology, I'd say 1/3 of it, we'll kind of skip to the next chunk and it'll kind of give you an introduction. So you'll just kind of be following along with me. And then if you have questions like on Monday about the material we like already talked about, feel free to ask me. Or you can shoot me an email. I don't know if you guys have my email. I can give that to you at the end of class, but feel free to reach out. But we'll just start where we kind of left off last week. And if you have any questions up until this point, please feel free to ask why. I'm going to quick pull up my notes to see where we were at. Okay, so last week we left off with payoff letters, and these were these letters that in a refinance, when you're getting a refinance on your property, you have to ask the current lender who has your loan for a payoff letter so that as you get a new loan, you know how much you have to pay the current loaner or current lender at that time. So that's kind of the payoff letter. So that's where we left off last week. And I'm going to jump straight into the term amortization. Has anybody heard of the term amortization? Rumsa, do you want to take a shot at it? What you think it means, or how you would
Amortization, isn't it like when you actually completely write it off? That's the point of amortization. Like, if it's a loan, if you're amortizing it, then that means basically you're paying it completely off, or you're getting it off the books.
kind of, I think you have something in your head. It's just not, I wouldn't say it's writing it off or getting it off. It's more of a calculation. It's how to calculate your payment on a loan. So there's a calculator, and you can actually like Google an amortization calculator, and you would put in the interest rate and the loan amount, and it would give you your monthly payments. And so it's a way to calculate it. And typically commercial real estate loans are amortized over 25 to 30 years. So an amortized loan is a type of loan with scheduled payments that are applied to both the principal amount and the interest accrued. And the first, so let me see how I can describe this a little bit better. So I'm going to read off an example to you guys and let me know kind of if that makes sense. So a borrower comes in and wants to buy a retail center for $2 million. And you tell her that you can lend them 75% of the purchase price for $2 million. This means the loan amount is going to be $1,500,000. The question is, how do you determine the payment they will pay every month? So if you assume that you use the 25-year amortization and a rate of 5%, so the interest rate would be 5% amortized over 25 years, that's how you would calculate the payment. And this isn't something that you can just like necessarily calculate in your head. It would be through a loan calculator. Sometimes they have it on like a Excel spreadsheet. And then sometimes they have it on, you can just do it online. And it would show you the monthly payments. So basically, instead of paying a loan off in like and it's basically making your payments smaller so that you can make those payments off in a 10 years. So it's breaking out those payments based on a 30-year or 25-year amortized loan, but the payments are going to be smaller. Let me see if I had a really good video on this that I think would help describe this.
I have a quick question.
Yes.
So the term, does it refer to the actual calculation of you trying to find the monthly rate, or is it the monthly rates itself that is amortization? I don't know if that makes sense.
Say that one more time. Sorry. I'm just
So when you say amortization, like I understand the concept, but is that you calculating the rate, or is it already the rates for the month and that's just called amortization?
it would be me calculating the rate. So
Okay.
it would be different for everyone. So it would be how you calculate the monthly payments based on how long it's amortized for. So 25 years or 30 years. Let
Can I
me
ask you a question?
Yes.
What's the difference in the amortization and depreciation then?
So depreciation would be how much it is going down in value, like how much something goes down in value, right? So that would be like if a piece of real estate or you have say an office building and you have a printer in there, a printer will depreciate over time, the value of it goes down. Whereas like amortization, that's the payments, that's showing you how much, when you get a loan, how much you're going to be paying each month. It's more of a payment schedule showing you how much to pay versus depreciation shows how much it's losing in value.
Okay.
I'm going to pull up this video if you guys don't mind. And then, because I think it breaks it down really good. Okay, do you guys see the little red screen with the amortization? Okay, hopefully this plays the sound. Let me know if it doesn't.
Hi, I'm Jack Guttentag, the mortgage professor. I've been helping borrowers understand their choices in the mortgage market for over 2 decades. Recently, I've been getting a lot of mail from mortgage borrowers asking about amortization. Most of my writers are considering whether to pay down their loan balance more rapidly and have suddenly realized that they don't know the best way to do that, or even whether it's a good idea. I suspect many of my readers never fully grasped how mortgage amortization works. So let me take a minute to explain the essentials of amortization and why in today's market it's a good idea for most borrowers to speed up the process. Almost all mortgages today have fully amortizing payments. This is a payment which in most cases will pay off a loan over its term. When received by your lender, your fully amortizing payment is divided into 2 parts: the interest owed to the lender and the principal, which is deducted from your loan balance. The interest portion of your payment is calculated based on your loan's interest rate and remaining balance. The principal portion of your payment is whatever amount remains after the interest portion has been deducted. As you'll see, while your total payment amount stays the same from month to month, your interest and principal portions change in size. For example, let's say you have a mortgage of $100,000 at 4% for 30 years. The fully amortizing payment for your loan would be $477.42. This is how much you would pay every month. You can Google fully amortizing payment formula if you want to know how to calculate that. To calculate the interest portion in month number 1, you multiply the balance of $100,000 times the annual interest rate of 0.04 and divide by the number of months in the year to get $333.33. When your lender receives your fully amortized payment, the first thing it does is to pay itself an amount equal to the interest portion. Your principal payment for the first month is what remains of your payment after paying your interest charge. Subtracting $333.33 from $477.42 gives $144.09 as the principal. Using this amount, your lender now reduces your loan balance to $99,855.91. Turning to month 2, your new loan balance can be used to calculate the interest portion of your fully amortizing payment. Since you owe a smaller amount of money to the lender, your interest charge for the month is 48 cents lower at $332.85. That makes the principal payment in month 2 48 cents higher at $144.57. This process repeats each month, with the interest gradually declining and the principal portion gradually rising. Every month that goes by, you're paying less and less interest because your principal balance is lower. One simple way to accelerate the payoff process of your loan is to pay some amount in addition to your fully amortizing payment. 100% of such extra payments becomes principal. Surprisingly, even small extra payments can have a large effect on your finances over time. If the payment in my previous example was increased by just $10 a month, you would pay off your loan 13 months early. And if you increased your payment amount by $100 a month, your loan would pay off 101 months early. That's nearly 9 years. Making extra payments saves you money by reducing your interest expense. Benjamin Franklin famously once said, "A penny saved is a penny earned." So you can think about these extra payments as investments that earn you a guaranteed return equal to your loan's interest rate, 4% in my example. Often, this rate of interest savings will outperform the yield on alternative investments. That's why paying down your loan balance is a good idea. The bottom line is, pay extra now, save extra later.
Okay, so does anybody want to like take a little stab at how they kind of interpreted that, or like how you're kind of understanding amortization and what it means?
I can give it a go.
Yeah, go for it.
So essentially what I gathered is that, say you owe that $100,000, you're paying back what's being covered by the lender. And then in addition, you're paying an additional amount that's going to essentially bring that total loan amount. So say like you took that $100,000 and you're making a $350 payment to the lender, and then that extra $50, say you pay a total $400, that extra $50 goes to the loan. That extra $50 is actually what's bringing the loan like down. And then, I mean, kind of what they said, how over time it, what does it go? Like that and that, right?
Yeah.
Or, it starts higher and then comes down.
Yep.
That extra amount is essentially just paying off the loan over time. So, any amount extra that you put into that, say if you do the $10 or the $100 extra each loan payment, that all is going to bring down your initial principal, and your principal is like the actual loan amount that was taken.
Right. Yeah. Essentially, yes. And I think like one of the big factors in there is like when you get a loan, they charge you an interest rate, right? So there's a rate that you're paying, and so you're paying that interest rate off, and as you pay the interest rate off, that the interest rate decreases over time, and you're paying off the principal, which is the amount without the interest rate added on, so the amount of the loan without the interest rate, and that is what is increasing over time. So yeah, it's a little bit of a kind of confusing concept, and it's a really important concept to understand, and to understand the payment. It's just a little bit hard to understand, especially when you're just like throwing these terms at you without having any like, understanding of the full breakdown of a loan. It can be a little confusing. So I know you guys will kind of touch on this more in future topics and kind of break it down even more, but this is kind of a high level overview of amortization, introducing the term to you guys. Does anybody else have any other comments or questions with that?
Yes, I do. Like, so basically the interest rate does not change, but because our amount for the principal changes, so we are paying the same interest rate, but a lower amount because our principal is going down. So that is the concept, right?
Yeah, so the
That's what I
interest rate doesn't change. Like you're not you don't start with a 4% interest rate and it's going down to like a 3% and then 2%. Like the interest rate's staying the same the whole time. You're just paying it off because you're making these payments to pay off this loan, right? Like the lender's lending you money and then you have to pay them back. And so this is just you're creating this schedule of like, okay, these are my monthly payments to pay this back over say a 10-year term would be a 10-year period to pay that money back, but it's amortized over 25 years. So it's smaller payment amounts for 25 years, but you're paying it within 10 years. So that's where it gets confusing. And each loan is a little bit different with terms and how long it's amortized for, interest rates. So it's so dependent on each different loan type. And as you guys probably can kind of tell, there's, bridge loans, there's hard money loans, and we'll talk about mezzanine financing, and there's what else did you guys talk about? Refinances. Like there's just so many different nuances that come with it. So okay, so hopefully that video kind of gave you a good introduction. I felt like it did a way better job of explaining it than I did. So just wanted to give you guys that intro. Back to the terms. One of the terms that you guys will go over is service contracts. And basically what a service contract is, this isn't super important, I wouldn't say, but just to bring it up. They're copies of contracts that are between third-party vendors, and we'll kind of cover more third-party information later on. But they're a contract between a third-party vendor and a property owner. So an example would be if you own an apartment building and you have a landscaping company come in and do all of your, mowing and weeding and whatnot, and you have a contract with them, this would be something that you would need to get a copy of, and this would be more applicable for loans that are done with CMBS lenders, which I know we talked about on Monday. So like once in a while, an apartment lender might request these, and they'll be collecting all these documents. It's just to have all these signatures. A lot of this stuff is more for documentation, keeping track of the different like services that they're providing within, they want to see the cash flow, they want to see how your business is working and what you're paying for. So it's just a general term, service contract, not super important. The UCC1 filing form is a uniform commercial code, and it is a statement of legal notice filed by creditors as a way to publicly declare their rights to potentially obtain the personal properties of debtors who default on business loans they extend to. Their notices are typically printed in like local newspapers in an attempt to let the everyone know of the creditor's intent, but they're required for all business loans, and they establish a relative priority over which specific assets may be seized and in what order. So basically, again, this isn't, I wouldn't say super important term to know. I will say that in the loan that I'm working on right now, they requested this, that they need a UCC filing, and oftentimes this is produced by a attorney, some form of legal counsel. So the borrower may have an attorney involved in the lending process to review things like loan documents, and like entity documents. And so one of the things that they may need to produce is a UCC filing, which is just a way to declare if the borrower defaults on a loan, how the personal properties would be obtained. Does that make sense to you guys? Again, not super important. Okay, sponsorship. Does anybody know? I think we talked about it one maybe in the quiz. What does the sponsorship refer to? Like who are they referring to when they say the sponsor or sponsorship?
Isn't it just the lender?
Close. Try again. It's confusing. You would think the lender.
Then I'm not too sure.
It sounds like the lender, like sponsor, but anybody else want to give it a shot?
Isn't it the person who's receiving the loan?
The borrower. Yep. So sponsorship, just a term to refer to the borrower. How about par? Anybody recall what par means, or if you have notes on it, give me a rundown of par.
Is the par like the par value thing?
Yeah, it do you want to give it a shot?
I know, I just know par in terms of bonds. Like the face value is also sometimes known as par value. So basically the amount, the full amount.
Yes.
I don't know how to say it.
No, that's okay. So par it means equality or normal, but in lending terms, it means the lender is quoting you with no origination fee, or par. So an origination fee, oftentimes when you get a loan, they're going to charge you, like the lender will charge you a fee for like basically producing the loan. So it's just a fee that you literally pays directly to the borrower or directly to the lender. They receive it for originating the loan, for developing the loan is maybe another way of saying it. But the reason that lenders do, they will do like a loan at par, which means no origination fee, is that as the broker, you may have the ability to charge a fee and the client does not feel that they're paying a lot of fees. So what you have to be careful with is if the lender is increasing the interest rate in order to loan it at par. So they may say, okay, we're not going to have any origination fee, but they may be increasing the interest rate so they still are getting paid an extra amount. You have to be careful with that, because from our standpoint at Integrity Capital, we want our clients to feel we don't want to do things behind their back, kind of like, really sly moves of like, oh, we're actually getting this money from you, but you don't really know that you're paying this money. And over time, like when you're paying a higher interest rate on something, like that's going to cost you a lot of money when it's a higher interest rate. So at our firm, we don't really accept like back end fees like that. Just because like the lender wants to increase the rate. So that's just something to kind of note, that as a loan associate, when you're dealing with lenders and they're kind of wanting to go this route, that's something to kind of have a red flag about and be like, is this something that we should be moving forward with? Like, we want to be open, honest, and transparent with our clients. We want them to trust us, and doing those kind of things could come off wrong, and just something to take note of. Secondary source of repayment, that's another term you guys will hear. So when lenders do their underwriting, which, side note, does anybody kind of know what underwriting means? Or when I talk about underwriting, does that ring a bell?
Isn't that just kind of like going through and checking things like credit score, like kind of all the background information, debt, like outstanding, anything like that?
Yeah, basically. So when lenders underwrite a loan, that's kind of going through their like approval process, making sure the loan cash flow, or the borrower's money cash flows, and then that they are okay to do this loan. And oftentimes they underwrite it and they will produce what we call a commitment letter. And a commitment letter is basically a letter saying that, yes, we will do this loan for you, as long as you provide all of the following documents and you get these reports completed and you pay this fee, we will provide you a loan. So they basically do their kind of behind the scenes work. They're, going through the tax returns and the entity documents and whatnot to make sure it like they approve of it. So that was just a side note, but secondary source of repayment. So when the lender is doing their underwriting, they usually are going to see if there's a secondary source of repayment, so if the primary source of repayment, which is the cash flow from the business or the property, if that fails to cover the payments, the debt payments or the loan payments, what is going to be the backup? They need to know that there's going to be something that will pay this loan off. So a secondary source of repayment is just another way to minimize risk, and most banks will look for a secondary source. The way they figure this out is by looking at their personal tax returns. So again, personal tax returns are super important to gather upfront from the client so that the lenders have that and can see that. Does anybody have any questions around that? No? Okay, so a discounted payoff, a DPO. Does anybody know or want to take a stab at that?
Sure, I'm just gonna take a guess here, but I'm assuming it's if the borrower wants to pay the loan off sooner, they'll give them like a reduced rate to pay it off.
That's a great guess. It's not necessarily that, but I appreciate the guess. And yeah. So it's where it's when the lender who currently has the loan is willing to take a discount off the face amount. So as an example, if you have a loan for $1 million, the lender might be in a bad situation and just wants to get rid of the loan. And so the borrower might negotiate like a discount, and so that the lender will take off the 100. So if the borrower wants to get like a 10% discount, they'll take off the $100,000 off the face amount of the loan. So now the loan they have to pay off is $900,000. So oftentimes, you say you have a refinance and you need to pay off that loan and the lender just wants to like get rid of it, then you could negotiate a discounted payoff. And when you do this, typically the lender is motivated to get out of the loan early. So again, I would say this is another term, one of those terms that like doesn't come up a ton, but just kind of keep on your radar. C&I loan is a commercial and industrial loan. Are these loans real estate related or non-real estate related? Would you take, like, what would you guess?
I would guess that that's non-real estate related.
What is everyone, Rimsa and Joey, what would you guys say?
I would go non as well.
Same.
Okay, you guys are all right. Great job. It's non-real estate related. So these are like business loans, working capital, accounts receivable, factoring, and so on. Many banks will do this with businesses as they develop their relationships. So as you develop relationships over time, sometimes they will produce these kind of loans. I would say this is another one of those terms, good to keep on the radar. It's kind of just a broad term, commercial and industrial loans. Non-real estate is kind of the big thing to learn from that. And then a legal lending limit. This is basically just the bank's max capacity at which they can lend to a borrower at one time. So banks have a capacity on how much they will lend to a borrower, because otherwise it is too risky to, if you keep lending all this money, like you kind of reach a point where you have to cut it off as far as like, this is how much I will lend a specific borrower. And for banks typically will lend $20 million to one borrower. And this happens to be 10% of the bank's assets. So Or sorry, that I was reading an example here. So for example, if the bank lends, sorry, scratch what I just said. If a bank lends $20 million to one borrower, and this happens to be 10% of the bank's asset, it can cause a major disruption if the borrower defaults. So just keep note of how much. I have had one situation where a client basically reached their capacity with a specific bank, and they actually they end up going to a different lender. So they had multiple loans with one bank, and then they had a couple other loans with another bank because they just reached the capacity. Okay, and then a rate lock agreement is designed by the lender who has to provide an agreement to lock the interest rate through a trading bond market. So I would say the biggest thing here, this typically, you'll hear this term interest rate lock agreement with CMBS loans. Again, these are commercial mortgage-backed security loans. It's important that the client is on the phone when you're doing these types of rate lock agreements, because you're locking in a rate and you want to make sure the client knows the rate that you're locking in and they're well aware that this rate can't be changed. So basically it's locking in an interest rate. And you just, when we discuss things with clients, we really want them to know and like never come back and be like, well, I never heard this, or I never, I didn't agree to this. You always want to make sure that they're in agreement with what is moving forward. So this is just something, again, to keep note. Rate lock agreements typically happen with CMBS lenders, and it's important that the borrower is with you on the phone. Okay, interest rate index. Has anybody ever looked up like the interest rates currently and like different interest rate index? No? So as you guys have probably like heard within the news and stuff, interest rates were rising rapidly for a while there. And these interest rates are based on a financial instrument to determine the kind of the benchmark of what the interest rates are in the market. They serve as so the interest rate index, that term is a benchmark to calculate the interest rate for the lenders on a loan. So many times a lender will tell you we are quoting that you at an interest rate index of a 5-year treasury plus a spread of 300. So if the 5-year treasury interest rate is 2.5%, then you take 2.5% plus 3% to get a 5.5% as the all-in rate. Whenever you hear a spread of 300, they'll use like 300 or 250. That in terms of interest rates, that means 3%. So 300 is 3%, 250 is 2.5%. Just take note of that. Like with interest rates, sometimes they use different terminologies. There's different indexes to use to determine the interest rate, like SOFR, it's spelled SOFR, or FHLB, that's another index. Why don't I look up that right now so I can kind of show you an example?
LIBOR is also another one, right?
Yes. So let's see here. Pull this up. You guys see the SOFR Academy? So it says today the SOFR, I think it stands for something, to be honest. but I don't know what it stands for, is 4.31%. So these kind of federal rates change daily. But oftentimes a lender will do like, they'll take the index rate and add on a spread of like 300. So like they said, you would take the SOFR rate of 4.31 plus the spread of 300 to get 7.31% for the rate. It's just another way of calculating, or it's a way of calculating the interest rate on a loan. And please stop me at any point if you guys have a question. And if I can't answer it, I will write it down and get back to you guys. Okay. So the next term is called yield spread premium. This is a little bit of a, I would say, confusing topic, but it's important to know. So a yield spread premium is a form of compensation that a mortgage broker, acting as an intermediary, receives from the originating lender for selling the interest rate to a borrower that is above the lender's par rate. It can sometimes be applied to cover costs associated with the loan so that the borrower isn't on the hook for an additional fee. Most lenders will quote the broker a rate and let them know they will increase the rate by 0.25 basis points. So like I mentioned with par, sometimes the lender will, not have an origination fee, but they'll increase the interest rate. A yield spread premium is where they will pay us as a mortgage broker, the intermediary, the person in the middle. They'll pay us the lenders will pay us a fee by increasing the interest rate for the client. So it's another kind of like behind the back, like the borrower isn't always aware that this is like kind of a fee being paid out to the mortgage broker, but if they're not paying us a fee up front, it's kind of, behind the back. So at our firm, we're not comfortable with this as we are not acting in the client's best interest. So it's just something that kind of another red flag. Keep in mind if a lender's kind of negotiating this kind of deal with you, like we're not comfortable at Integrity Capital with doing a yield spread premium, just because it's not in our client's best interest because they're going to have to pay more over time. And if they are if they're paying more over time without them knowing, for us that's like an automatic no. So does anybody have a question about that?
Is that somewhat similar to like stocks when a company takes something IPO and then when they sell it to smaller kind of brokers to offer to the public, say they sell it for 62 and then the small brokers sell it for 64, then they make that $2 spread. Is that somewhat similar?
That's a really good question. It sounds similar. I'm not super familiar with like how stocks work, if I'm gonna be honest. But I'd be interested to look into that. It does sound similar, so I'm kind of curious if it is. But I don't know.
Gotcha. Thank you.
Yeah. Okay, so the next term is capital stack. So capital stack is just an industry verbiage to say or to show how the purchase of a real estate is happening with respect to the financing. So when someone says, what is the capital stack? They're basically saying that if the property is a $1 million purchase, then how much is the debt? How much is the equity? How much is the financing? So it's just another verbiage terminology you'll hear in the industry, and they're just asking kind of how is the purchase of real estate happening? Not super important, I wouldn't say, but good to know. Has anybody ever heard of mezzanine financing? Rimsa, you want to give it a shot at what you think it is?
just a try, but isn't it based on like, okay, from what I know is like mezzanine financing includes both equity and debt financing.
Yeah, it's like a hybrid of the equity and debt financing. Yeah.
Okay.
Yeah, great job. So like she said, it's a hybrid of debt and equity financing. So mezzanine debt has embedded equity instruments, and these are known as warrants, but it increases the value of the subordinated debt and allows greater flexibility when dealing with bondholders. So when somebody comes in and wants a loan and they want to get a loan, the lender will only offer 75% of the purchase price. Well, sometimes that means, sorry, let me back up a second. So the lender says they'll offer you a loan for 75% of the purchase price. And that means you have to come in with 25%. Say you don't have that money at that time. Mezzanine financing allows you to come in with less money because it's a hybrid between debt and equity financing. So basically, this would allow the lender will give you an additional 10 to 15% above the 75% LTV or loan to value to get that up to 85 to 90% of the total debt. So that means that you would only be coming in, so the cash equity that you'd be coming in with would be 10 to 15%. It's often though way more expensive than the traditional loan, because interest rates are like, they range from like 10 to 20%, and it can be really hard to obtain because there's a lot more risk involved in it. But it is a way to, if you know you're like if it's an investment property and you know it's gonna produce a lot of cash flow and you're gonna, make a lot of capital from it, then oftentimes people want to go this route because you might not have the money coming into the purchase to get this loan, and so you need the lender's help to kind of get you started. But if you produce a ton of income, you can end up paying it back. So it's just a way to kind of get on your feet and get going. It's just oftentimes way higher interest rates, and it can be a lot more risky. And I would say not as many lenders do this, but there are certainly people who do. Okay. Let's go to, so I mentioned loan to value or LTV, and then there's also LTC or loan to cost. When I refer to that, does anybody know or want to take a guess at what loan to value means?
Wouldn't that be like the percentage of the loan to like the value of the property being offered? So like, say someone had, $900,000 and they needed to get in $1 million property, would the loan to value be, or maybe that's a bad example, but am I off base here? Where I'm isn't it like the value of the property that they're willing to like reimburse up to?
Yeah, basically, I think you're on the right page. It's shown as a percentage. So an LTV or an LTC is shown as a percentage. So it's, if you have a 75% LTV, it's 75% of the purchase price that they will lend you money for. Or so LTC is usually for construction, so the cost of the land and you know how much it's going to cost to build it. LTV is usually land to value or loan to value, because you usually get an appraisal done and they'll give you the value of the property. So it's based on how much the appraiser values the property at. So the LTV would be how much loan to what it's worth, basically, is what it's saying. So how much the lender will offer as a loan amount relative to the value or the purchase price or the construction cost. So I'll give you a little example. So say you have a total construction cost for an apartment project of $10 million. The borrower might ask for 75% loan to cost, which would be $7,500,000. The lender will generally only do a loan to cost or loan to value, whichever is less. So if the property appraises for 15 million and the construction cost is 10 million, they will only do 75% of the purchase price as opposed to 75% of the value of 15 million. So they'll take the lesser of the two. So if it appraises higher than it actually costs, they'll take the lesser amount and do the loan to value of whatever is less. And then I would say that this would be one of those terms that is very important just to know and understand, because you'll see it on every single deal. The lender will give you the loan to value that they'll offer the client. And this is where I feel like appraisal reports are super important. So when you go through and you get, say somebody has an apartment building that they want to get a loan on, it's going to be super important to get you have to get an appraisal report done. So they'll get an appraisal report, but one of the reasons it's super important that the value comes in at a high rate is because they want to make sure they're getting the max loan to value that they can. So the higher the value of the property, the more loan to value they will get. So it's just I would say this term is something that like super important to know. You'll hear it a lot in the industry, and as a loan associate, you'll be dealing with that, and you'll be using that calculation a lot. Okay, so in creditor agreement is an agreement among lenders or classes of lenders describing their respective rights and obligations with respect to the borrower and its assets. I would say this is a term I personally don't hear of a lot, but it's just an agreement between the lenders and to show their rights. And this usually is applicable for like mezzanine financing. So kind of like we were talking about with mezzanine financing, where the lender will come in with they'll come in with more equity than they have an agreement between the lenders to show. Kind of just to break it down, it's agreements you'll see in the commercial real estate world, like you'll see them all the time, just different forms of agreements. This is just a term to keep in the back of your head. I wouldn't say I've honestly ever heard it in the industry, like as in my career, I haven't heard it, but I'm sure I will. But another thing just to know. Kind of as the last thing to wrap it up today, just because we got about 5 more minutes. We briefly touched on recourse and non-recourse loans last time. Joey, do you remember which one is like no personal guarantee? Like they won't default on you as a person.
Non-recourse.
Correct. Good job. So yeah, personal guarantee, recourse or personal guarantee basically means that you'll be on the hook for something. So when you sign a personal guarantee, basically you're giving the lender the right to pursue you if your loan ever defaults. I would say, typically borrowers are looking for non-recourse loans just for that reason, but sometimes they don't offer that. So next week we will jump into third parties. We kind of just went over high level all of the lender terms for now. We'll jump into third parties and then kind of go into more of the asset information. I would encourage you to try to get through, because I know, so we'll be meeting next week, Monday. That will be the last day to touch on terminology from the capital markets like meeting standpoint. So if you guys can get all the way through by Monday, I think that would be ideal. But if you're still finishing up the last little bit, Monday night or Tuesday, whatever, that's fine. I think it'd be best to start jumping into the next material. So lesson 4, I think, by Wednesday. That way, when you kind of are introduced to the new material, you kind of have a heads up and stay on schedule, right, and just stay on top of things. But does anybody have any final questions, thoughts, or anything else they'd like to share with us?
I have a question like regarding recourse or non-recourse. So if it's a